You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is time once again for TWIFO. This Week in Futures Options, the program where we break it all down, everything lighting it up to the light side and the dark side over there at CME Group this week. My name, of course, Mark Longo from the THEOptionsinsider.com. I'm reminding you a couple of things here at the top of the show. First off, if you like what you hear on TWIFO, there's a lot of other stuff hitting the network, so if you're just listening to the TWIFO, man, you're missing out. Make sure you're listening to the full Options Insider Radio Network feed. Wherever you get this show, it's available on just about every platform under the sun these days. B, if you do like it, throw a rating, a star, a like, a comment, whatever your platform lets you do. All of it in aggregate does help new people continue to discover the content. And we all know there's a lot of new people discovering these markets every day. And of course, if you want to discover more content in your lives, you think it's time to turn your trading and indeed your listening up to 11. Only one place to go, theoptionsinsider.com/pro. The place to go to get great pro Q&A sessions, exclusive shows like Options Oddities, live access to this, everything else we do. All sorts of fun, great giveaways. Only one place to see it all, theoptionsinsider.com/pro. And you may be saying to yourself, what is TWIFO doing coming at me on a Wednesday? Well, yes, a special early edition of the show this week. And why is that? Well, because we have joining us in the CME Group hot seat this week, our old friend, Mr. Blue Putnam, the chief economist over there at CME Group. Blue, welcome back to TWIFO, sir. It has been too long.
Well, thank you very much. This is great.
Yeah, Blue, my producers tell me it has been quite a while since we've chatted, almost exactly a year, actually exactly 11 months as of today, sir. So a lot to catch up on in the world of research. Let's start, Blue. You know, we do these pro Q&A sessions on the pro side, and we've had a chance throughout the year to pick the brains of a lot of different people over there. And what we've been asking them, in addition to all the listener questions, is kind of gauging their outlook on the markets at the start of the year and, of course, how the year has unfolded compared to their expectations, any surprises, things that really kind of stood out and resonated to them. We obviously haven't had a chance to do that with you, so we're going to do that now, Blue. We're going to have a little mini pro Q&A session with you right now. Obviously, it's been a crazy year, a topsy-turvy year, all sorts of things going on in the equity markets and other markets. For you, as you look back on the mad year that has been 2023, sir, what really stands out? What resonates to you? And how is this year unfolding compared to your expectations, sir?
Well, I had a reasonably good year in the forecasting department for once. When 2023 started, even late 2022, most market analysts were pretty pessimistic about the economy. There was all this recession talk. And, is inflation going to come down? Is it going to be sticky? All those things. And, at the beginning of the year, I really did a lot of research and made 2 points. One, that we weren't going to have a recession in 2023 just because interest rates went up in 2022, that the lags are much, much longer and the economy is a lot less interest rate sensitive than it used to be. And then, on the inflation side, the thing that I kept focusing on was, what caused inflation? Well, it was the $5 trillion of fiscal spending, the $5 trillion of quantitative easing, and the supply chain disruptions. And all of those factors were reversed in 2022. So I didn't see any reason why inflation couldn't come down pretty quickly. So, but those were contrarian views at the beginning of the year. But by the end of the year, they're pretty well accepted. But the debate continues about whether we'll have a recession or not. But inflation has clearly come down fast. So, that's kind of where my take is.
Well, you definitely stand alone in that one, Blue. I'm hard-pressed to think of anyone else who rotated through our pro Q&A hot seats, especially in the early part of the year, that weren't doing exactly what you said, talking about recession, extolling the virtues of cash, saying, go to cash now. Things were looking pretty dire. I don't think anyone had the massive AI-driven boom in the equity markets in their back pocket at the beginning of the year. So there you go, Blue. A good year for you.
I definitely didn't have that AI boom either.
Well, you did pretty well otherwise here as we keep on rolling. Before we get into all your research, and there's a lot of it, listeners, let's cut our teeth really quickly with a little bit of the old movers and shakers report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, welcome to the Movers and Shakers Report. And if you can't tell already, it's going to be a little bit different show this week. We're going to mess with the usual format a little bit, except for right here at the top of the show. You've come to know it. You've come to love it. We cannot deny you the Movers and Shakers Report, a.k.a. everything that's lighting it up to the light side and to the dark side over there at CME Group. Of course, you folks can find those reports for yourself if you follow CME Group or us on Twitter. We both tweeted out there right before showtime. And if you did check out the report this week, you would see, probably as a surprise to no one, that the market's pretty heavily biased towards the green. Looks like it's roughly 70-30 green over red. So we could certainly assemble a dark side bottom 5, probably a bottom 10 if we got pretty crazy with it. But beyond that, not too much. But that said, Mr. Blue, as our guest for the first time in nearly a year, sir, where should we begin our journey this week? To the light side or to the dark side, sir?
Oh, you got to start with the dark side so we can end on an optimistic note.
I like it. All right, man after my own heart. To the dark side we go, listeners. And again, not much to speak of here, but we'll scrape together what we can. Number 5 to the dark side this week. We're starting off in the energy space, in particular, heating oil off 5.13%. So bit of a drubbing out there this week. Number 4, from the energy to the metals, it's palladium off 5.76%. It was number 5 in the same direction last week, off 2.43%. Remember, we are coming at you a day earlier, so just bear that in mind as we're talking about the numbers here, listeners. Number 3, platinum. So staying in the metals, off 6.16%. Number 2, back off to the oats. It is number 2, off 6.26%. It was number 1 in the same direction last week, off 4.53%. So a rough couple of weeks out there for oats. And then our number 1 dark side mover, one of our frequent offenders back in the mix, it is nat gas off 8.69%. And also, even though I said it was light side outnumbering dark side, that is certainly the case this week. But in terms of largest percentage mover, we do have nat gas taking the crown this week. Now to the light side we go. And again, there was an embarrassment of riches here. we had to cut it off at 5. Of course, we could probably do a top 30 easily here on the old top 5 light side here. Number 5, it's back to the ags. It's soybeans, up 4.89%. Number 4, these sectors we've been talking a lot about, the S&P sectors, making their way back onto our radar again. Number 4, it is the tech sector of the S&P 500. Oh, surprise, surprise on that one. Up nearly 5%, 4.97%. It was number 2 in the same direction last week, up 5.84%. So a good couple of weeks to belong some big tech out there. Number 3, it's the consumer discretionary sector of the S&P 500. Also a good week out there, up 5.05%. It was number 1. It led the dance last week, up 6.19%. Number 2, one of our old frequent offenders. We had to kind of rotate it off, but making it back onto the list this week, it is lumber, up 5.37%. You know, for the early years of the pandemic, 2020, 2021, into early 2022, lumber, I think you could argue, was the most volatile asset we talked about here on this show. It was whipping all over the place week after week. For the lion's share of 2023, it has been much quieter, so not really one of our big top 3 frequent offenders anymore. But today coming in at number 2, and then the number 1 light side mover this week, soybean meal, up 7.25%. So there you go, listeners, a little bit of an early edition of our movers and shakers report. But let's get into some of your research now, Mr. Blue. I think we're going to start in the rates.
The Fed, the yield curve, inflation fears. How are they impacting options activity and volatility in your favorite interest rate products? Let's find out as we explore the world of rates.
All right, everybody, welcome to the wonderful, the topsy-turvy, these days head-scratching world of rates. Blue, you've been crunching a lot of numbers in a lot of different markets, including an intriguing paper you just came out with about a week ago. So listeners, all these papers, all this research we're going to talk about, you folks can find it over there on the CME Group website. Just go to the research tab and just be warned, set aside an hour or two because you're going to go down some rabbit holes, but they're probably going to be pretty fun and probably pretty interesting along the way. But let's start with one that caught my eye, Blue, kind of a 10,000-foot paper you just put out. An interesting one you call the case of round numbers, kind of breaking down the importance that these key psychological levels, these key round numbers have in a wide variety of complexes, not just the rates, sir. What was catching your eye, and what were some of the interesting findings you have in that report, Blue?
Well, I really, when round numbers become important or psychological, you know, they become boundaries. And, you know, if you remember from your high school math class, well, maybe college math, but anyway, boundary value problems are inherently complex. And that's certainly true in markets. The two that I was focused on was the 5% yield for the U.S. Treasury 10-year note, which I think is a ceiling. We'll see if that works. But basically, you know, we went up and kissed the 5%, then we rallied back down to, you know, 4.6, 4.57%. So a big range there. But, you know, what the market is really debating is how low inflation is and whether it will stay there and whether we'll have a recession in 2024 or not. And so, you know, as I look at it, we're already at pretty low inflation. The round number that I focus on for inflation is actually 2%, the Fed's target. But I calculate it differently than they do. I really don't like the owner equivalent rent calculation that is in the various inflation indexes. Owner equivalent rent makes up 25% of the CPI. And it's a mess. It assumes you rent your own house to yourself and you get paid. And it even includes that money in personal income, like you can spend it. You know, it's totally a fiction. And it lags. It lags by about 12 months. So it's, you know, there's a reason it's the slowest part of inflation to come down because it's a fiction. And anyway, if you take the shelter component out of the CPI, the headline CPI ex shelter is already at 2%. So, you know, it makes me feel like that we're in a good place on inflation. And so, you know, I'm comfortable with the 5% being a ceiling. But, you never know. If it pushes through, these things can go pretty far. So there are two scenarios all the time. The other round number that I focus on is the yen. If you quote it in yen per dollars, it's 150, which is a round number. And the yen has bounced above it and below it and above it and below it. It's dancing all around it. But it looks like the Bank of Japan is going to remain very accommodative compared to any other central bank. They may start to raise rates in 2024, but they'll do it so slow and they'll be well behind everybody else that, there's a pretty good case that 150 can become a floor and you can see it go to 160 or 170. But there's still a case that if the Bank of Japan moves more aggressively, it could go the other way. By the way, I'm quoting the yen versus dollar. If you trade in futures on the Japanese yen, it's dollars versus yen. And that would be 6666. Actually, 0.666 is forever, which makes it an irrational number, by the way. So I think, the pretty good chance that 150 is going to flip from ceiling to floor. But, these are debatable things. We'll just have to see.
666, also a bit of an ominous number there, Mr. Blue, yeah, to focus on. Speaking of numbers, you brought up something that is very interesting to me and something that's really seemed to caught a lot of people's attention, particularly in the last few months. All of a sudden, I've heard a lot more debate about this than I have in recent memory. I know at the recent risk management conference, the subject of the volatility of inflation became a subject for debate. You just mentioned how this notion of what the Fed uses for inflation is a bit of a fiction. I was taught, I'm sure you were taught in our early economic classes, that was the Fed's target. That 2% rate for CPI is kind of what the Fed was honing in on. And it's, at this point, almost accepted wisdom in the market. We all just kind of say, okay, the Fed's targeting 2%. That's just what they do. And recently, I've seen a lot of pushback on that, saying, why? Why are we targeting 2%? Where does this number come from? Is it outdated? Is it, as you mentioned, kind of a bit of a fiction? I'm curious, where do you fall on this overall debate? Is 2%, is that still a reasonable benchmark, a reasonable target for the Fed, or they may be relying on some outdated metrics, some outdated numbers, and maybe it's time to revise this gold standard of 2%, Blue? Where do you fall?
Well, the 2% really comes from the work of Nobel Prize winner Professor Milton Friedman back in the 50s and 60s, when he argued that economies don't do well with zero inflation because there's a certain amount of illusion. You need a little bit of inflation to make people feel a little better. And so he argued that 2% was the right number. We think he wrote it down on the back of an envelope, but then later on he wrote some papers, and the Fed has really, and many other central banks, have felt that was a good standard to have. Now, my own view is that what you would like to do is be a little more flexible. I don't think there's anything particularly religious about 2%, but, I am in the camp that you don't want a lot of inflation. So, 2 to 3% would be fine. So I would argue for some flexibility, but the Fed is really locked in on the 2% right now. I do think that will be a debate within the Fed in 2025. And the reason I say that is that Jay Powell's term as chairman will be over. We'll have a pretty new Fed, and they will get to decide if they want more flexibility. But in the meantime, 2%'s the goal. The other thing about 2% that's interesting is that the Fed chooses the personal consumption expenditure price index without energy and food. Back when they chose that, and even today, it's typically the lowest inflation indicator. So they kind of chose the easiest target to hit when they chose that. And, that's a debatable question, too. So, but right now, the Fed's locked into 2%. It's locked into its target. And, they're going to stay high for longer, as Jay Powell has said, while they try to get down to that 2%.
Interesting. Where do you fall on that list? Maybe that'd be a good question of the week out there coming up. So producers, take note. 2%. Is it still a viable target, a viable metric to focus on? Or maybe should we be focusing on other things, other levels out there? Blue mentioned the 5% yield out there on the 10-year. I know the 10-year is where a lot of you like to focus these days out there on the yield curve. So we're going to hang out there right now. Go into your cmegroup.com/TWIFO page. You're going to start there, of course. Then you're going to go to that drop down. We're going to go all the way down near to the bottom to interest rates and then U.S. rates and then slide down to the 10-year, listeners. If you do that, you'll see it's actually kind of a quiet week after, the rip-roaring week that was last week. This week on the rates front, a little bit sleepier, 1.6 million contracts. Now, there's a lot of products that would kill to put up 1.6 million contracts, don't get me wrong. But from a 10-year perspective, not blowing the doors off by any means. And of that, refreshingly, almost 41% of that paper going up in the D's contract. Now, it's not as far out as you might think. It's only got 16 days to go. So it's effectively a 2-week contract. But from an equity perspective and from a lot of product perspectives these days, 2 weeks is an eternity. So we're going to go out there ourselves, listeners. The 10-year hanging out 108.11 right now, off slightly on the week, pretty much unched. In terms of vol, the 10-year, not exactly a bastion of volatility, trading at 7.25. That vol level also unched. I think if you could describe it as unched, that's kind of the general term to describe the 10-year this week. Volume, kind of unched. Vol, kind of unched. Underlying level, kind of unched. Not a lot tearing it up out there this week. In terms of skew, again, not a lot to expect out here. The puts were flat last week. They're about 2% bid. That's about as exciting as it gets out here. The calls last week, 1.2% rich. This week, about 1% bid. So talk about a point or two premium in either direction, which isn't much. But then again, when your baseline vol is 7.25, it looks a little bit more impressive, I suppose. And in terms of action, what was leading the dance out here this week? It was the 106 even puts. So almost exactly 2 point out of the money puts out here leading the dance with 70,000 contracts exactly. A weird round number going up. Remember, listeners, we're coming at you a little bit earlier this week as well. So that also accounts for some of the light volume numbers that we're talking about here. Usually we have another full trading day in the bag by the time we fire up the old TWIFO machine. And of the 106 puts, of the 70,000, 46,000 going up on Tuesday. Pretty much all opening there, 14,000 on Monday, and about 10,000 almost going up today, 9,000 and change. The OI coming into today, 75,000. So today's paper, anyone's guess what they're up to. And then behind that, we have, actually, you have to jump a little bit. We go to some near data paper. 2 days and change for the 108.75 calls. So there is some near data paper going up here in the 10-year. These going up 54, almost 55,000 times. A kind of even and steady paper throughout the week. 18, almost 19,000 on Monday. 18,500 on Tuesday. 17,000 today. Pretty much opening throughout the week. And today's OI on the strike, 21,000. So today's paper, anyone's guess as well. So kind of a bit of a mixed bag. We have the 106 puts going away in 2 weeks. And then the 108.75 calls going out in a couple of days, leading the dance out here in the 10-year. But Blue, we have to keep on rolling. Well, actually, before we do that really quickly, since we're hanging out in rates, you kind of mentioned the recession metric. I know it's not just you over there on the research team. You've got your buddy, Mr. Eric Norland, who's been on the show many times in the past as well, also crunching numbers. I know a lot of your research recently has been around, can we avoid a recession, the R word? Kind of hit on some of this already, but your buddy, Mr. Eric, also kind of hitting on this in a recent report/video. And they're putting up a lot of videos over there on the research tab as well, titled exactly that, can the U.S. avoid a recession? You kind of touched on this earlier, Blue, but maybe let's get a little more into detail on this before we roll out of rates. Why exactly do you think we've been so nimble? Why do you think this much ballyhooed R word that everybody was talking about at the beginning of the year, we're still talking about it at the end of the year, and it isn't here, Blue?
Yeah, the main argument for a recession is the inversion of the yield curve, where short-term rates are higher than long-term bond yields. And the inversion really was pretty decisive back in the fourth quarter of 2022. Now, the research on yield curves, inverted yield curves, is it takes as much as 18 months before the recession appears. So if you do that math, you would be expecting the recession in the second quarter of 2024. So we're not really out of the woods. And that's the controversy that many people are looking at. And you can make an excellent case that the U.S. economy is going to slow down in 2024. Job growth was just exceptional in 2023, and then that's unlikely to last at that pace. And job growth drives personal consumption, so that would slow down. But the question about a recession is typically when you have a recession, something breaks and it ripples through the economy so that unemployment rises quite quickly. And we had something break in March of 2023. We had regional bank, Silicon Valley Bank break, and it could have spun out of control. But the regulators went in and really ring-fenced it so that it did not spin out of control. So the yield curve might have been early if it hadn't been for that regulatory action. But now as we look at 2024, I'm slightly in the camp that we won't have a recession. But I do believe the economy is definitely going to be slower in 2024 than 2023. So, you're going to have to live with this debate a while longer.
Well, it makes for good radio at the very least, Blue. But interesting, you're kind of, once again, alone in the camp. You would have been pretty alone in the camp at the beginning of the year saying we're going to have a decent year this year, at least avoid the recession. I don't think a lot of people would have agreed with you then. So far, that's working out, and it sounds like you're in that camp again for next year. Everyone's waiting on pins and needles for the dreaded R word to begin, and you're saying you don't think for next year, Mr. Blue. So interesting prediction, sir.
Well, the thing about it is, last year I was much more confident. As I look at 2024, it's a closer call on recession because I've joined the camp with people that the economy is definitely slowing down for 2024. And it can always slow a little more than I think, or something like that. So it's going to be a closer call in 2024. But, when I look around to see, well, what could break that would really ripple through the economy, I just don't see it right now. But, those things are always a surprise. So we get the email after it started, And I would caution you on thinking about how the Fed will react. If we don't get a recession, then they've told us they're going to keep rates higher for longer. If we do get a recession, they might be a little late this time because they want to make sure that inflation comes down. So, but when they do lower rates, if we get a recession and if they start lowering rates, the rates will, when they start coming down, will come down faster than the markets think. That's pretty much the historical trend. When rates start to go up, the market underestimates how far they're going. When rates start to come down, the market underestimates how far they're going to be cut. But the thing is, we have no clue on the timing. So it's quite an interesting, my crystal ball is pretty cloudy here.
Blue, just when people were hoping maybe we could shift away from watching the Fed every single day to dictate what the markets are going to do. It sounds like 2024, unfortunately, going to have more of that in store for us. And what's in store for us next, listeners, is a little bit of a sojourn out into the land of commodities. In particular, we'll kick things off in the metals.
Werewolves beware. It's time to explore the options activity in silver, gold, and other shiny things. It's time to talk metals.
All right, listeners, a lot to analyze on this side of the tape as well, including another research paper Blue just put out entitled, appropriately enough, What's Behind the Commodity Slump? Again, this kind of covers a broad cross-section of products, including, let's go base a little bit today, listeners, a little bit of copper. We don't get the chance to talk about copper on the show too often, listeners, for obvious reasons. When you're talking about metals, leading the dance is going to be gold. And then behind it, we have some action out there in silver, of course. But, the base metals, they do get up to some paper these days, even though copper, obviously, it's the early part of the week. So not blowing the doors off, not much really blowing the doors off out here this week. But from an economic standpoint, copper, certainly a great indicator. So, Blue, you've been crunching the numbers. Tell us, sir, what is behind the commodities slump, sir?
Well, if we talk about copper, economists call copper actually Dr. Copper because it's a very good indicator of the health of the global economy. And the biggest part of the global economy that's not doing well right now is China. So if you look at the weakness in China, and this is something I definitely got wrong in 2023, I thought when China came out of their COVID zero that they would grow faster than they did. But they haven't done all that well. They've still got a debt crisis. They have a very high rate of youth unemployment. They can't really get out of it. They have a long-run demographic problem with their aging population. So China's been been quite weak. And when China is weak, it's very hard for copper to rally. So that's really, China is the copper story.
All right, and looking here in the metals, listeners, again, go to that drop-down, cmegroup.com/TWIFO, pop out of the rates and go up to the metals. Normally would sink our teeth into the base, but right now it's early in the week, only 11,000 contracts really going up so far in copper. So instead, we'll go out to the one that usually leads the dance in the metal space, which is, of course, gold. Surprisingly active out here right now, nearly 200,000 contracts on the tape already, in spite of the fact that we are coming to you fully one day early here. So interesting paper out here and a decent amount of paper out here in gold. Where are we hanging out in gold right now, listeners? At about a 1960 in that front future, off almost exactly 40 handles. So retreating right away from one of those key numbers there, 2000. Blue, you mentioned your key psychological levels at the top of the show. You were talking about 5% yield. You're a number of the beast out there in the yen. But another one we hear a lot out there is, of course, 2000 for gold. That's one that a lot of people tend to bandy about. In your analysis of round numbers, how integral, how important is that 2000 level in gold, or is it kind of overhyped and maybe some of the other ones you were talking about, like 5% yield in the treasuries, is that more of an indicator of the health of the economy right now, sir?
Oh, no, 2000 is a serious psychological barrier. We crossed it just briefly in 2020. We got back up there in early 2022, or almost there. We got there in 2023. And most recently, the Middle East geopolitical turmoil has sent it back to almost 2000. And then, it's, as you said, it's dropped off to 1960. But, we have a gold is really determined, has three major factors in my view. Gold doesn't bear any interest, so the U.S. at 5% plus interest rates is a negative for gold. Gold, I think, is a better hedge against dollar weakness than anything else. People think of it as an inflation hedge, but I think of it more as a dollar weakness hedge, and the dollar's been stable to strong, so that's been a headwind for gold. But geopolitics is definitely given gold a lift. And so, for gold bugs out there, and you're looking at it, you're really looking at what's happened, what's going to happen between Russia and the Ukraine, what's going to happen in the Middle East, what's going to happen with U.S., China. The geopolitics are the big story for gold right now. And if we're calming down just a touch on that, that's a headwind for gold. But the other two things on gold, rates and the dollar, are negative for gold, but geopolitics has been a big positive. So that's kind of my analysis on the gold side.
Yeah, geopolitics, the big wild card out there in gold right now. Clearly 2000, as Blue mentioned, an important level. We were just at it last week, coming away almost exactly 40 handles in that right now to pull us down to 1960. So everything obviously has been vacillating around 2000. Very recently out here, and again, a surprisingly active week. 31% of the paper going up in the DEES contract that has about 19 days to go. So that's actually surprisingly near dated for gold as well. What is the vol in gold right now? Again, kind of like the 10-year, not really a bastion of volatility are the metals. 11.5 is the DEES gold vol right now. So if you're wringing your hands about VIX and other metrics saying, man, vol is too low right now, here's an 11.5 for you in gold. That's off about a quarter of a point right now. So not a huge move on the vol front this week. Skew-wise, gold tends to historically be bid to the upside, and that remains the case this week. Last week, the puts were flat. The calls were slightly bid, about 1.5%. This week, the puts get a 2% discount, and the calls 5.3% bid. So the skew leaning towards a little bit of bias to the upside, but not a ton. We've seen gold get much more bias to the upside. In fact, if we scroll out to, let's say, DEES of next year, listeners, or forget that, let's go out to DEES of 2025, listeners, those calls are nearly 20% bid. And the put's 7% cheap. So it shows you the farther out you go in time, the more pronounced that bias is to the upside in the calls. In terms of action, what was leading the dance out here this week, listeners? And it's actually an interesting contract. It's not in the D cycle. Usually it's one of these kind of straightforward. December usually leads the dance a lot. Doesn't matter when you are trading during the year. December always popular for gold bugs. But no, it's actually the February 2080 calls, again, the future at 1980. So these are exactly 100 handles out of the money calls, going up about 12,000 times this week. The big day was Tuesday, about half of that, 6,200 on Tuesday, 5,700 today. Obviously nothing to speak of on Monday. The OI coming into today is 8,000. So today's paper, if past is prologue, they're probably piling on, adding more. I don't think they're taking off the calls with 1 day worth of trading, but you never know out there at the end of the day. So 2080, exactly 100 handle out of the money calls by February of next year. We're used to seeing a lot of upside in gold. This isn't even that optimistic. It's only 100 handles. We've seen a lot wilder out there. But there you go. That's what's leading the dance out here in gold this week. Not a strike I would have guessed. I would have kind of fixated more along the lines of blues, a round number phenomenon. But that's why we crunch the numbers every week out here, listeners. Intriguing stuff to be found out here. Before we keep going, maybe an interesting side area of the metals. Obviously, these are not optionable, but they're intriguing and worth noting. Again, your colleague over there, Mr. Eric Norland, as he is wont to do, he likes to explore sometimes the lesser known, lesser trodden reaches of the market, including moving beyond gold and even copper, talking about lithium and cobalt. Again, not optionable products, so not things that make it onto our radar these days. But he kind of pointed out recently, in fact, just yesterday, that open interest in those products, I should say, are soaring even as the prices are plunging. Blue, are these markets that you pay attention to, and what is catching your eye out there in the nether reaches of lithium and cobalt, sir?
Well, these are products that go in every electric vehicle, and they're very important for electric vehicles. So to the extent that we know that electric vehicles are gaining market share, that a whole variety of manufacturers, auto manufacturers, are shifting more and more resources to electric vehicles, that we just know that they're going to be both hedgers and speculators on lithium and cobalt, because you can't really do batteries without these things. And of course, you can't drive an electric vehicle without a battery. So this market is just going to grow. And right now, there's a little bit of China's not, as we talked earlier about China and copper, but, China is probably the largest market for electric vehicles right now, and they're not growing. So, the economy's not growing. So there's a little bit of pessimism there. But if you look out 3, 5, 10 years, lithium and cobalt are going to be very important products related to the transition to electric vehicles. So that's really the story there.
As you might imagine, no real options action to speak of yet in these. The futures are growing, and particularly in cobalt. I'm looking at it right now, listeners. We have kind of a light day today, but the day's just getting started. But yesterday, actually, one of the more active days we've seen in a while, maybe driven in part by Eric's paper here. We saw about 340 contracts changing hands. So one of the more active days, usually it seems to top out around 200 to 250. So interesting little spike out there in cobalt. Hopefully someday soon we'll have optionable markets in both of these, and we can start breaking these down on a regular basis here over there in the land of all things TWIFO. Speaking of TWIFO and our frequent offenders, let's keep on rolling, listeners, because it is our number one dark side mover. It's kind of hard to escape it. Let's touch on a little bit of energy.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, listeners, pop out of that drop down for the metals. You're going to go up about 4 slots to energy. Then you're going to go into product family. I think we're going to dive into nat gas. Blue, as I mentioned, our number one dark side mover this week is natural gas. It seems like that is the case pretty much every week. Nat gas definitely gets our frequent offender award for 2023. It fights its way onto the show almost every week. It is pretty much inescapable. I know we haven't been talking about your research in the energy space, but obviously this is a big complex that is top of mind for a lot of our listeners, even ones that don't normally pay attention to the commodities and indeed to the futures options markets, sir. So what is catching your eye out there in the energy complex, Mr. Blue?
Well, if we're talking natural gas, it's a highly volatile commodity because you don't ramp up production quickly on it. So if you get a change, particularly in the U.S., if you're thinking about Henry Hub natural gas, which is what trades on the CME complex, if you get a really cold streak of weather this winter, and by that I mean really cold, then you're going to see a spike upward in natural gas. But, we've had warmer winters in the past, so, it's a very volatile commodity. Summertime doesn't affect natural gas as much as winter. When you have a hot summer, maybe you use more air conditioning, that's electricity, but natural gas doesn't really respond to summer heat, but it does respond to super cold. So that's one thing happening in natural gas that people are looking at. They're trying to figure out the weather. It's good luck, And then the second thing about natural gas is if you look around the world and you try to analyze what kind of ships are being built. Well, the biggest ships and the most ships being built today are actually liquid natural gas, LNG ships. And the idea there is that the U.S. has some of the cheapest natural gas in the world. Natural gas is expensive in Europe and Japan. So they're building more ships. So if you take a 5-year view, which I realize is a little long for some of the traders, but if you take that longer view, we're going to export a lot more natural gas. And that's going to lower natural gas prices in Europe and Japan, but it's going to raise them in the U.S. So the long-term outlook for natural gas is pretty positive. The short-term outlook is all about the weather and whether we get a super cold winter or not. And I'm afraid I'm out of my league on that one.
Oh, Blue, I know you. You could talk a good El Nino and La Nina with the best of them, sir.
I can talk about La Nina and El Nino, but that's not really that's not what's going to drive whether we get a super cold winter. We're talking about these polar vortexes and whether they show up or not. That's when the Arctic air kind of gets a hole in it and comes flowing down into the United States from Canada. And those are really related to the stability of the jet stream. And again, it's beyond me. But, you look at the experts, and they are talking about a fair amount of snow this winter in parts of the U.S. So we'll just have to see. It's going to be an interesting winter, that's for sure.
I think you're selling yourself short, sir. I think you missed your calling, Blue. You ever thought about going back a second degree in meteorology?
Well, I'm a sailor. And every sailor I know is an amateur weather forecaster because we don't want to go out and have a storm hit us. So that's about the extent of my expertise.
It's all about self-preservation out there. I get it. You know what, listeners? I said we're coming at you early this week, so I expected a somewhat light week on the Nat Gas front. And Nat Gas said, heck no, listeners, already right now. Usually we expect by Thursday's show, we expect somewhere around 450,000 contracts. So coming into today, I expected maybe 300,000, maybe less. No, already, listeners, there are 610,000 contracts going up in Nat Gas this week. So a banger week for Nat Gas. As I mentioned, our number one dark side mover, Nat Gas, talking about round numbers again, Blue. For a while, it seemed like 2 was the one everyone was fixating on in Nat Gas. Could we break a 2 handle? These days, it's all about 3. We're at 308 right now. In Nat Gas, obviously coming in hard this week, listeners, off 43 cents, or about 12%. So again, that's just since Monday. Of course, you go back to our show last week, a different story. But again, just a lot of dark side. And again, maybe threatening that 3 strike. What is the vol in Nat Gas? Again, Nat Gas, kind of the standard bearer these days in terms of products trading at CME, leading the charge from a vol perspective, at least in terms of the active liquid products. 67 right now, up 3.5, so blowing the doors off most other products we're going to talk about out here today. Skew-wise, the puts last week, nobody really cared, 1.7% cheap. This week that has changed a little bit. They're actually cheaper, 3.4% cheap. So that's kind of surprising. You might think maybe if people are concerned about blowing through the 3 handle, that they might be bidding those up, but that does not appear to be the case. The calls last week, 3.8% bid. This week, catching almost a full 3 points, 6.6% bid. So the calls are bid, the puts are offered. This looks like a modest gold skew or precious metal skew if I had to look at it without any context to it out here. So interesting stuff here for Nat Gas, maybe showing that folks aren't concerned that we're going to break through the 3 handle in the near term. They're expecting maybe a little bit of a retracement. That said, though, it was the 3 puts, going back to Blue's round number fixation. 3 puts in the Dees contract that were leading the dance, by the way, of the paper going up this week, of the over 600,000 contracts. 51% going up in the Dees contract. That has 19 days to go, so we're going to hang out there as well. And the number one most active contract are the 3 puts. So again, Going back to our round number fixation, it's clear here. 16,000 going up on Monday, 11,000 on Tuesday, and about 10,000 today. Worth noting, looks like it's closing most of the week, and today's OI, there's about 38,000 open, so today's 10,000 could be closing as well. And you might be surprised by that, but it makes some sense. We have fallen pretty sharply to the three handle. A lot of people probably had three puts in their back pocket for just such an occasion, and they are now taking them off, as you do when your hedge works out. You take it off, listeners. Otherwise, it does nothing for you. So that's probably why we're seeing a lot of closing paper on the three strike today. If we blow through the three strike, that may start to change a little bit. But right now, as we're getting right to it and then bouncing off, folks taking their three puts off. Right behind it, though, we do have opening on the 2.5 puts for size, about 35,000 of those. So we could also have some rolling going on here, listeners. Again, about 16,000 were going up to the three puts on Monday, 18,000 of the 2.5 puts going up on Monday, mostly opening, I should say. So could be some rolls, some verticals going up, 11,000 of the three puts traded on Tuesday, and about 10,000 of the 2.5 puts opening on the 2.5 puts. So again, probably some rolling going on there as well, and about 6,200 of the 2.5 puts on going up this morning. So again, very, very active were the three puts and the 2.5 puts in nat gas. So that's too far. If you how about the 2 3/4 puts going 32,000 contracts again opening there as well. So maybe some folks were rolling to the 2 3/4 puts as well. About 11,500 going up on Monday, opening there 11,000 even on Tuesday, and about almost 10,000 today. Worth noting there are about 30,000 contracts open coming into this morning. So today's paper could be anyone's guess, but looks like a lot of opening on the 2.5 and 2 3/4 puts. Closing on the three puts makes a fair amount of sense given the price action that we're seeing out there. All right, Mr. Blue, we are coming up against it. We got a few minutes left here in the show. We have covered a wide variety of complexes already. We talked about energy. We talked about metals. We talked about rates. But before we roll out of the show, Mr. Blue, is there any other research that's really top of mind for you that you want to break down or share with our listeners? Now is the time, sir. The floor is yours.
Okay. Well, let me share two very different things. We were talking about climate just a minute ago, and I can tell you what I'm really looking at in terms of the global economic picture is I'm very worried about rivers and canals. The Amazon, the Mississippi, the Danube, the Rhine River, the Panama Canal, they're all very low on water. And that really affects global shipping and global trade. So I'm watching that very carefully. But, you know, when the Panama Canal is low on water, they have to ration how many ships go through, and that will slow down global trade. When the Mississippi River, for instance, is low on water, the corn and the soybeans and the wheat that come down the river in barges, they can't load as much on a barge because they want to float higher. So, that's one of my current research is to try to understand how important rivers and canals are to global trade. And the answer is it's really important. Another thing I'm studying is artificial intelligence. You know, everybody's taking a look at AI. And what I'm looking at it in terms of, what are some of the, I guess you might call them best practices, but some of the things you have to understand if you want to use AI for trading and investments, what are some of the rules or at least some guidelines that you might want to think about? And, the first thing is that it's really a pattern recognition tool. And the patterns in financial markets are dynamic. That is, you get a shock to the system, something changes, and then we have to learn how we're going to react to it. So you can't just use AI as some kind of stable system. You have to figure out how to make it learn quickly when there's a shock, and then that's going to be a challenge. The other thing about AI that you have to remember is that it depends very much on the quality of information you give it to work with. And I'm in the camp that says you have to curate the information, curate the data, be very, very careful of what you give your AI system. Because basically, you probably heard the term GIGO, garbage in, garbage out. Well, AI is a garbage maximizer. Put a little garbage in and you can get a landfill out. So you have to be exceptionally careful about the quality of the data you give it, and you want to curate it. And then you end up with a partnership with the human and the AI, with both helping each other. So that's where I'm doing a good bit of research now as to how to use AI. And it's very, very promising, but you have to be very, very careful.
Well, Mr. Blue, that's why we like having you on the show. You always have some surprises up your sleeve. I could have maybe guessed AI. I did not expect you to delve into the levels of canals and rivers, sir. I like that. So a fun curveball. Can we look forward to a paper coming from you on maybe the surprising correlation between the level of the Panama Canal and the S&P 500? What do you think?
Well, indirectly, yes, because we're going to look at the Panama Canal and other shipping channels. And then we're going to look at global trade. And, of course, if global trade is weak, then so is the global economy. And then we'll get ourselves eventually to the S&P.
There you go. Panama Canal drops an inch. S&P drops 5%. There we go. Let's just draw the line in the sand right now. Instant correlation. And, Mr. Blue, if folks want to check out your upcoming papers and all of the papers we broke down on the show today, where should they go? What should they do, sir?
CME.com, go to the research, and you'll find lots of things.
He is not lying, listeners. You will find lots of things. As I mentioned at the top of the show, if you go there, strap in. You're going to be there for a little bit. Of course, you can go to Quick Hits. They do 2-minute videos. Blue and Eric are doing their best to steal my thunder, Blue, and do my job with videos and podcasts and all that fun. You can find all that over there, cmegroup.com. Normally, we go to the TWIFO page, and that's where we recommend everybody starts. But, of course, if you want to check out all of the great research that Blue and Eric and the rest of the team are doing, just click on the research tab. And you know what? We're not done here on the network, not by a long shot, listeners. We'll be back in a little over an hour. It is Education Wednesday, after all, so we'll be back with Options Boot Camp, holding court on some great educational topics, probably tackling a lot of your questions with myself and maybe some special guests, so that should be fun. Look forward to that. Then tomorrow, of course, coming back at you with episode 2 of your bi-weekly options extravaganza known as the Option Block. I think I will be live over there at the SIBO with our friend the Flowmaster, so that should be fun. And then Friday, of course, coming back at you noon Central, 1 p.m. Eastern for volatility views. And after that, exclusively for your pro folks, breaking down the week from an unusual activity perspective on options, oddities. You want to check out all that pro fun, including 250-plus archived episodes waiting for you the second you hit that button. Only one place to go, theoptionsinsider.com/pro. Then we're back again with our usual array of content, including back again on TWIFO on our usual time next Thursday, listeners. Until then, stay safe out there.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.